Bonus depreciation is not new. In fact, it's been around since 2001. Believe it or not, there were 7 different tax bills with bonus depreciation provisions. The Job Creation and Worker Assistance Act of 2002, this is where the 30% bonus was first introduced. The Jobs and Growth Tax Relief Reconciliation Act of 2003, this is where bonus was increased from 30% to 50%. The Economic Stimulus Act of 2008 reintroduced the 50% bonus. The American Recovery and Reinvestment Act of 2009 extended the 50% bonus. The Small Business Jobs Act of 2010 extended once again the 50% bonus. The Tax Relief Act of 2010 extended the bonus through 2011, but also increased the percentage to 100% for 2010 and 2011, and then brought it back down to 50% for 2012. And now, here we are with the American Taxpayer Relief Act of 2012, signed into law on January 2, 2013, which extends the 50% bonus through 2013. For aircraft and certain property having longer production periods, it's extended through 2014. Congress has used bonus in the past to stimulate the economy, and they apparently felt we needed to continue stimulating the economy by offering businesses a way to accelerate their depreciation deductions for purchases of their business assets. The idea here is to generate investment, which in turn fuels job creation. So how does a bonus work? Well, it's quite simple. You determine if the asset is eligible for bonus. If it is, you take the basis and you multiply it by the 50%. And this is the amount of bonus depreciation you're allowed to deduct in the year the asset was purchased. You then reduce your cost basis by the amount of bonus, and this remaining basis, this is what you depreciate over the appropriate recovery period. You'll find bonus depreciation rules in the Internal Revenue Code section 168K and the related regulations. One of the questions we are asked most is, what property qualifies for bonus depreciation? The 50% bonus depreciation applies to most machinery and equipment and other tangible personal property, most computer software, and certain leasehold improvements placed into service before January 1, 2014, or January 1, 2015 for certain property with longer production periods and certain non-commercial aircraft. The original use of this property must begin with the taxpayer. In other words, it has to be new property. It cannot be used property. Qualifying property includes maker's property with a recovery period of 20 years or less. Computer software is defined under Section 167F1, water utility property, and qualified leasehold improvement property. These are the same requirements for qualified property that are defined in the tax code for all of the previous 30, 50, and 100% bonus depreciation, and so this should all sound familiar to you. It's important to note that there are no dollar limits for bonus depreciation like there are for Section 179 deduction. And in fact, businesses must claim the 50% bonus depreciation unless they opt out of it. If they decide to opt out, they are required to opt out on a class-by-class basis, and the election to opt out must be made by the due date of the return, including extensions. The various property classes that apply to opting out are 3, 5, 7, 10, 15, and 20-year asset classifications. And so, for example, let's say you purchase a 5-year asset and you do not wish to take the 50% bonus depreciation. You must opt out of it for all of your 5-year qualifying assets that you place into service during that tax year. Bonus depreciation is not prorated in a short year, and so if you decide to change the month in which you end your fiscal year, which results in a year consisting of less than 12 months, you still get the full amount of bonus depreciation for that year. You'll be happy to hear there is no AMT adjustment needed for assets claiming the bonus depreciation. What this means is that bonus depreciation is also allowed for alternative minimum tax purposes.